Hey everybody, today I want to do a short video on the QBI deduction, the Qualified Business Income Deduction, or the Section 199 Cap A deduction, and specifically how it affects expats. So, as with most things with expats, there's the general rule and then it's how it applies to you when you live outside the US. There's always a catch, there's always a little additional thing that you have to look at, and that's what we're going to talk about today. One will be the gotcha, to make sure that you're doing it the right way and not doing something incorrectly, but also how to plan for the QBI deduction so you can potentially get the best of both worlds. If there's a benefit you're getting from a tax perspective of being outside the US as an expat, how do you marry that up with the QBI deduction? Because sometimes they can be mutually exclusive. So that's what we're going to focus on today, how to look out for the traps, but also how to plan into the opportunities. So how does the QBI deduction work in general? The QBI deduction was created in 2017 as part of the Tax Cuts and Jobs Act. And basically what it does is it gives a 20% deduction on your qualified business income. So to put that simply, that's flow through business income. So if you have a sole proprietorship or a partnership or an S corporation, anywhere where you're paying up the income from that business and paying tax on it personally, as opposed to paying tax on it at a company level, like a C corporation. That's where the QBI deduction kicks in. So for example, if you have a sole proprietorship in the US and you earn $100,000, that 20% QBI deduction gives you a 20% deduction on your net income. So then you would only pay tax on $80,000. Or if you have a US rental property and it earns $20,000 during the year, you could get a $4,000 deduction on that rental property directly. So it's a direct 20% deduction. And just to give you a little bit of history, the reason it came about was because one of the biggest provisions of the Tax Cuts and Jobs Act was that the corporate tax rate was reduced from 35% to 21%. And it was a pretty bad political look, obviously, if you're giving this huge tax break to corporations, whereas a flow-through business is still paying tax at 39.6%, which was the highest rate at the time. And most businesses at that time, and still, are operated in pass-through capacity, S corporations, partnerships, sole proprietorships, definitely small businesses. So to try and placate that imbalance, they created this 20% QBI deduction to, balance out those two provisions, basically. So it does not apply to wages and salaries. Obviously, it doesn't apply to C corporations for the reason I just mentioned. It doesn't apply to passive income, dividends, capital gains, interest. It's specifically for business income flowing through. And we'll talk more about this in a minute, but it doesn't apply to foreign sourced income, which is a little bit of a misnomer. It's not exactly correct, and we'll talk a little bit about that in a second. Which is not exactly correct because certain foreign source income actually can be applied if there's a U.S. trade or business. But we'll talk more about that in a second. The limitations I want to point out really quick. If your income threshold, so total income before you receive this deduction, is under $198,000, and these are 2024 rates, they change for inflation, or under $397,000 if you're filing jointly, you don't have to worry about these limitations. You just get the qualified business deduction. If you're over that threshold, then there's a limitation for specified service trader businesses. So basically they carved out consulting businesses. Not exactly sure why, but a political move, and they carved out, think about things like health, accounting, what I do, legal. If you're over that threshold, you're a specified service trader business and you have a limitation. The other limitation, if you're over that income threshold, is wage and qualified property limitation. So basically, your 20% deduction is limited to 50% of your W-2 wages that you pay out, not your W-2 wages, or that could be included if you're paying yourself W-2 wages, but your business's W-2 wages as a whole, or 2.5% or 25% of your W-2 wages and 2.5% of your unadjusted depreciable asset basis. That's just to say, know those thresholds for the income, and just know you need to look up the limitation if you're over these thresholds. If you're under it, you don't have to worry about it at all. So that's the basics of how the QBI deduction works. But how does it work for expats? So I mentioned earlier, foreign source income can be a problem. What the specific rule is that the income has to be effectively connected with a U.S. trade or business. So, the common examples that I see for expats is, say, a sole proprietorship outside the U.S., or if you're operating through some type of flow-through business outside the U.S., where the services are being performed outside the U.S. That's not going to be effectively connected with a U.S. trade or business. Even though maybe you're a U.S. person, all the services are done outside the U.S., so it's foreign source trade or business. You're not eligible for the QBI deduction. You are likely eligible for the foreign earned income exclusion. And that's a good thing to point out, that those two things are mutually exclusive. If you have income that's eligible for the foreign earned income exclusion, it can't also be eligible for the QBI. Now, we'll talk about different ways we can plan around that in the next slide, but that's the general rule. Same thing with foreign real estate. If you have a foreign rental real estate property, or a property outside the U.S., and you're managing that property outside the U.S., or someone is, it's not going to be effectively connected to a U.S. trade or business, and therefore you're not going to get this QBI deduction. So those are the things to look out for as an expat. This QBI deduction works a little differently. So the last thing is, and the important thing is, the planning opportunities. What can we do to maximize this benefit, or at least try to get a little bit out of it as an expat? I'm going to talk about two specific opportunities that I see. The first one is with real estate. So maybe you're not an expat and you just have real estate outside the U.S. that you're renting out. In that case, if you're inside the U.S. managing that property, even though it's abroad, and you're keeping books and records inside the U.S., the case law says that that is a U.S. trade or business. And again, everything that I'm saying here with the planning, it is very fact specific, but so I'm giving you general rules. You can't just take this and run with it, but we'd have to look at your specific facts, but this is the general planning opportunity. If you're in the U.S. and the activities and management of that business, the foreign rental business, is being conducted inside the U.S., you have a U.S. trade or business, even though it's foreign source income. And I would argue in that case, you still have an eligible QBI deduction. If you're outside the U.S., one of the opportunities you have, if you're outside the U.S. and you have a rental property outside the U.S., one option would be to get a management company inside the U.S. So if you have somebody keeping your books and records in the U.S. and it creates a strong enough agency relationship to someone physically performing services in the U.S., that could be enough to trigger a U.S. trade or business and therefore make it eligible for the QBI deduction. That'd be one important thing to look into, and something I look into for my clients. The other is with service-based businesses. So I mentioned earlier, if you have a sole proprietorship outside the U.S., you're an expat, you're getting the foreign earned income exclusion, generally you're not going to be eligible for the QBI deduction. And that's the same as if you have a U.S. LLC and there's no people in the U.S. Let's say you're the only one providing the services for that business, but you've moved abroad and you're still providing services for the business. Maybe it's U.S. customers even. You have a U.S. business. If there's no physical services being performed in the U.S., it's going to be really hard to argue that you have a U.S. trade or business, even though there's a legal entity there and U.S. customers. So one thing you can do is you have to create some type of physical presence in the U.S. Or, what I do with my clients, say a very common scenario that I try to use is with a U.S. S corporation. S corporations can be tricky when you live outside the U.S. because usually you're trying to maximize that foreign earned income exclusion potential. With an S corporation, the only part you can exclude is the W-2 wages. And that's okay, because that's going to be foreign source. You're going to be providing your services outside the U.S. But if it's an S corporation, say you have contractors or other people performing services in the U.S., and maybe you even have an office in the U.S., and that will create a strong enough relationship in the U.S. to where you can get the foreign earned income exclusion on your W-2 piece, but the business still is a U.S. business. Even though you're providing services for the business too, it's a U.S. trade or business creating effectively connected income. In that case, you can benefit from both the foreign earned income exclusion and the 20% QBI deduction. So those are two real common examples that I like to use to try and maximize the benefit of both. But the point is, it's not a given that the QBI deduction is going to apply if you're living and working outside the US. Remember that we always have to look at your specific facts and circumstances, but there are opportunities out there for expats. You just have to know what you're looking for. So make sure you're getting good advice, obviously. And thanks for watching. Yeah, check out my other videos on this things. I'd give a lot of videos on instructional videos on expat specific tax items. So check me out and like and subscribe.